We're here back with Ed Sullivan, talking about the construction industry and the impact the current war in Iran, data center growth, and the general economy is having on the construction sector. Ed, the rates are kind of like the hinge of everything, right? I mean, we talked last time about how that's kind of a signal, and Kevin Warsh, who just succeeded succeeded Jerome Powell as the Fed chair, you know, we don't know yet how he's going to react, right? He's kind of signaled that he's very independent of the administration and political influence. Our economy is, let's say, running fairly well, it seems. As we talked earlier, it kind of seems that way, and maybe things aren't as bad. It looks like things aren't as bad as we think they are. But you mentioned back in July that it may be likely that the Fed raises rates this year in the next meeting in September. So, he just presided over his first meeting. He signaled independence from the pressure to cut rates, because I think that's what the administration would like to see. You wrote that he may not cut it at all and may even raise it. So help us understand why that is not automatically bad for the construction sector.
So let's look at a couple things. Number one, Kevin Warsh. There was some speculation. How independent was he going to be from President Trump? President Trump wants him to cut rates dramatically.
Sure. Yeah, right.
And I was a little concerned about that. But I've watched him and I've listened to him, and I think he's going to be just as independent as Powell was. So that's number one.
Mm-hmm.
They come from different perspectives. Kevin Warsh has a track record of being an inflation hawk. In other words, no, he doesn't tolerate it. And he certainly said that in many of his press conferences. Number three is he's saying that 2% is the target. And the latest inflation print was 3.4. Oh, that's an improvement, but it's still very high. The question now is, and at the same time, what you also saw is a loss of jobs in July. That's a weakening in terms of the economy and what have you. So how do you digest this? Job losses, you should be cutting rates if you think it's large enough and sustained. Inflation high and elevated, you should be increasing rates. So he's got a dilemma here. I think right now, Warsh will probably, and this is a tight call, but he'll probably sit on the sidelines the next call, September. Then there's another Federal Open Market Committee meeting in October. Probably sits again. If inflation remains high, that gets embedded in interest rates. In other words, if I lend you money, you want to get paid back in real spending power.
Mm-hmm.
And I have to take into consideration what the expected inflation is and embed that in my interest rate. So if he does nothing and inflation remains relatively high, rates rise or stay high, and that will cool the economy.
Okay.
It's kind of a thing. Here's the issue. We focus so much on what the Fed is going to do. Are they going to cut? And we think that has an impact, or a significant impact, in terms of construction. And it does. It signals where they see policy actions impacting long-term inflation.
But doesn't that only really affect maybe housing or residential segments, and not necessarily infrastructure?
Correct. So it actually affects people at the short end of the loan rate. So in other words, people with credit cards, mortgage rates, that's the long end. That's a 30-year commitment you're making. So what really determines the rate of those loans is the long-term or the expected inflation rate. That's what's important. I think I've mentioned before, interest rates follow inflation.
Mm-hmm.
You take care of inflation, the interest rates will fall. Maybe not as fast as you'd like, but that's where the focus should really be on, is not so much the short term, what the Fed does. It's what's happening to inflation near term, and also how that impacts expected inflation.
Okay.
That's what's going to impact construction activity.
So I guess you brought that distinction kind of forefront recently, and you said that short rates follow the Fed. Construction is determined by long-term rates, which price expected inflation in, basically what you're saying now. But, I mean, how does an inflation-fighting credibility from Warsh kind of pull the long-term rates down that would help, let's say, infrastructure spending?
Great point. I think there's going to be two issues here. Number one, to the extent that Warsh is tougher in terms of his stance on inflation, and that might mean an increase.
Mm-hmm.
You know what? That eventually sends a signal that he's tough on inflation with higher rates or elevated rates, and that will eventually curb inflation. It takes time, but that's what happens.
Right.
Okay.
Right.
So it's not a process that happens quickly. In fact, that's critical when you start looking at the timing of our recovery in construction, et cetera. But that's how it impacts. There's a second thing that's very important here. When we talk about long-term rates, it's not only expected inflation, it's the spreads, the credit spreads, risk. Risk is amplified during times of uncertainty.
Mm-hmm.
So when you have uncertainty in the Middle East, when you have uncertainty regarding tariffs, when you have uncertainty regarding even immigration, we have a job a shortage of construction workers. Those all get buried into the credit spread, which is added on top of the inflation.
Okay.
So that also has an impact.
So I guess this delayed payments and let's say credit utilization rates that are increasing also play a part in the buildup of a foundation of the economy, moving in the positive direction or the negative direction.
Sure.
Yeah. Okay.
Absolutely.
So I mean, you've always told me that the rate cuts take about 18 to 24 months to really hit the construction market. So from our perspective in this industry, when everyone kind of gets their eyes on interest rates, and you talk a lot about interest rates to our listeners, I don't think many people really understand that.
Yeah.
You don't think that it takes that long to kind of show up. Could you kind of explain to us a little bit?
Yeah, the actual thing is it's the full impact of a interest rate change, increase or decrease. It's typically 18 to 24 months, maybe even longer on the whole economy, the full impact on the economy. So it's a little bit different. Now, how do you know that? Well, there've been a lot of studies. The big one is Milton Friedman. That's what he did, and pretty much everyone falls in line because his results were pretty much right. That's not to say that you don't start to get interest rate changes and impacts almost immediately.
Mm-hmm.
The full impact comes further down the line. And think about it. I lower the rates. Well, the banks have to readjust what they're going to offer. There's going to have to be people who are going to evaluate their projects under the new interest rates. They got to start new pro formas, et cetera. Then once they get the loan, then it's buying the sites and et cetera. That all adds up before you start getting an impact in terms of pouring concrete.
Yeah, I mean, I think in the construction sector, I mean, project owners, and general contractors typically try to time the project with interest rates. 5 years ago, it was a little bit more predictable. Today, not so much.
Right.
This creates an immense amount of volatility, and anytime there's volatility, you mentioned higher risk. There's also higher costs.
Sure.
For businesses at individual segments of this that can't necessarily hedge such a volatile, environment. I want to go back to something we talked earlier, and it's sort of a sidetrack, but I think it blends into this discussion. You mentioned to me that cement or concrete utilization rates were in the 80s and now in the 70s. At what point does that? What's the threshold of utilization rates in concrete and cement production that result in a slowdown or a curtailment of capacity? Is there a general number? Is it 60s? Is it in the 60s? Is it down to 50s? I don't know.
I'm not sure what you mean by curtailment of capacity.
I guess what I mean is that in general, in most manufacturing environments, if you hit a certain utilization rate in your facility, it becomes less, let's say, less beneficial to keep operating. It's better to shut down. Mm-hmm. Is there a general utilization rate threshold in the cement and concrete industry?
Yeah, and it's. I think each company probably has their own different one.
For sure, yeah.
But you know what? The cement industry is unique. It's unlike the steel industry. Most of the imports that enter the U.S. market are imported by the domestic players. Imports do not enter the cement market as a competitive threat as they do in the steel industry.
Right.
They work with them. They are being brought in by the cement players. So you start to think about this. Yeah, your overhead, your capacity is extremely important in terms of your overall cost structure. Mm-hmm. So what they typically do is as conditions ease, you cut back on imports, boosting the utilization rates a little bit to above that threshold where they can still make money.
So they have a little bit of wiggle room to quote unquote manipulate their utilization rate to keep it to a sustainable level.
And imports account for 25% or so.
Yeah, sure.
So that's a considerable lever. Mm-hmm. Now, more recently over the last few years, you've seen more and more independent importers come in. But that's.
I mean, this all ties back into interest rates because interest rates impact currency, and currency impacts imports. So that's all related together. As interest rates rise or inflation rises, in this case, we have changes in currency exchange rates that favor or disfavor certain importers and certain countries of origin. This kind of ties me back into, and it really just confirms what you're saying, is that interest rates are kind of like the key domino in the set.
Right now. That's
right now.
True. Yeah.
Okay, fair.
It absolutely is true.
Fair point.
Yeah.
Back to interest rates. So, I mean, your threshold has always been, at least recently in the last couple of years, 5.5%. Mm-hmm. You see that as a tipping point. When that happens, if interest rates, short-term rates go to 5.5%, or let's say mortgage rates, I'm talking mortgage rates here. Mm-hmm. Mortgage rates go to 5.5%. That releases basically a built-up demand of about 4 million homes, plus minus, right? And rates have fallen in the past couple of years, but now we're possibly going in the other direction. Yeah. So are we saying that there's going to be kind of a pause in the possible recovery from the residential side?
You hit it right on the nose, okay? So look, I think I mentioned that early this year, we had mortgage rates below 6%. It was 5.98.
Yeah.
And that magic number is 5.5. We're getting close. Mm-hmm. Now, look, once it hits 5.5, it's not,
Oh, I know. Yeah, it's a continuum, yeah.
But it's significant. It will unleash a lot of demand for residential. And guess what? Non-residential will lag roughly a year later. So it does open up that sequence of a strong recovery.
Starts a process.
So yeah, it's a critical factor. I had expected to get near the 5.5 toward the end of this year, prior to Iran. Right now, I think you're going to take maybe a year longer before you reach that. Okay. So that's suggesting that big push to release pent-up demand, etc., probably doesn't come forward till 2028.
Okay. So if we look at the different segments of the construction economy, the single-family buildings, multifamily, commercial, public-funded projects, who's most sensitive to interest rates? Is it who stops building when they get too high, and who starts building when they get low?
It's gonna, in my mind, it's residential, single-family residential.
Always going to be that. That's the kicker, right?
Yeah, because it's the consumer that's so sensitive to that.
Yeah, right.
You know, when you move into non-residential, it's not just interest rates; it's also the strength of the economy. What does the return on investment look like? And that means your leasing rates have to improve and your vacancy or occupancy rates have to improve. Those are conditions that can take some time. Single family buyer, you hit my affordability number, bam, I can go in and buy. But the economy has to recover and show some momentum in addition to the interest rate decline before you see some of those non-residential
How do rents play into this? I mean, you've got housing and mortgage rates, but then the counter to that is rent, people that don't own. How is that adapting to this volatility in interest rates and in the economy in general?
Well, it's the same thing. The stronger economy creates more jobs. More jobs, you have more occupancy in multifamily. More occupancy drives up your rents a little bit. Okay. But look, there's a second part going on, Lou. There's a lot of people in the 30s, 40s. They can't buy a single-family home. Right. The prices are just so high.
Yeah.
And so what they do is seeing some strength in condo sales and in townhouse sales. Townhouses are considered part of multifamily.
Yeah.
And so what you've got is that dynamic happening. An affordability problem in single family is in part resulting in some strength in the multifamily. And of course, that also plays into the retirements.
Yeah.
You retire, you go into a condo, et cetera, et cetera.
Right,
so,
right.
It's a situation where right now the multifamily had a good year last year, maybe overbuilt in certain areas, but it remains, in my mind, one of the stronger players in terms of residential.
So I want to wrap up here, but before I do, how do businesses in the construction sector? I mean, we've got a long value chain. We've got it's a very multi-segment industry. It involves people from different backgrounds and different disciplines and obviously different company structures. But how does this industry work with this volatility? I mean, how do companies handle this and think about how they should make decisions, investment decisions? How do you make an investment decision in this environment? Not knowing fully what's happening, if it's direct. I mean, it's okay if you knew that it was going up, you could at least gauge and measure some kind of risk for that. Yep. But to have it completely going in any direction at all, how do people deal with that?
It absolutely will hinder the strength of the recovery. Even when the interest rates go down, if this uncertainty continues, the growth rates and of that recovery will be somewhat softer. It won't change until that uncertainty is eventually removed.
Got it. So there's a saying that the private work kind of waits on rates, waits on mortgage rates or interest rates. Public works waits on Washington, and we know how that's going. Mm-hmm. So and we'll talk about that next, about the highway bill and how that affects the construction industry. Very engaging conversation. Ed, thank you so much for coming in. Appreciate it. Good to see
Thank
you.
you, Lou.
Thanks.
Thank you.